Well, thank you everybody for joining me today. I am excited to be meeting with you again. We had a nice session yesterday, and today we are going to be talking about really one of my favorite topics to discuss in the currency markets, and that is the Forex mysteries revealed. And as I was trying to decide what to titled this presentation. I was going back and forth between Forex quote unquote secrets and Forex quote unquote mysteries. And I thought, the one of the questions that I often get is what's the secret to trading? What's the secret to consistently making nice returns, bringing those profits in, and being a successful Forex investor? And really, the only answer that I can give anybody is there's no secret. There's nothing out there that is hidden in some dark corner that you can't know about and that you have to dig around and find. But really, the information is there for us all. We do have to find it. But with today's topic, I wanted to talk about some of the mysteries of quote unquote why the forex market behaves the way it does and why we have the experiences we do in our own trading, and also as we look at it to answer some of the basic questions, like today we're going to be talking about how do you calculate the value of a pip when you're in a trade and you make 10 pips on a trade. How much money is going to be coming into your account? Well, it all depends on the currency pair you're trading, and we're going to take a look at that. We're going to take a look at the calculation for rollover interest to see how that is determined. So some of these topics we're going to be covering are really, they're not secrets. The information is out there, but oftentimes it's those small things that as we're going through our daily trading lives, we say to ourselves, I wonder how that works, or I wonder why that is the case. So let's go ahead and get started. The first is, where does all of this Forex trading take place? And this chart is from the Federal Reserve Bank of New York, and you'll notice that there are three major participants in the currency market. The largest trading center by far is the United Kingdom. So London is really the center of the Forex world. That is where most of the trading takes place. The next largest trading center is the United States, New York. So it is about half the size of the trading that takes place in London. And then the next one down is Tokyo in Japan, which is a little larger than half the size of the trading that takes place in the US and about a third the size of the trading that takes place in the UK. Now, as you go around the rest of this wheel, you'll see different places. You'll see Switzerland, you'll see Australia, you'll see Canada. One interesting place that you won't see is New Zealand. And really, the popularity of the New Zealand dollar has really only taken hold recently as interest rates in New Zealand have been so high. On an economic basis, New Zealand really isn't a major player in the global economy, nor are they a major player in the Forex trading world. But some of these other places that we see, like Australia, like Canada, like Switzerland, we a lot of forex traders pay attention to the Canadian dollar, the Swiss franc, the Australian dollar, but we've also pulled the New Zealand dollar into the fold because of the extremely high interest rates that New Zealand is paying currently. And we're going to talk a little bit more about the interest rates in New Zealand as we talk about how to calculate the rollover interest. So knowing this, knowing where the trading takes place, that most of it happens in the UK, followed by the United States, followed by Japan, that can help us as we look at the trading day. Because as traders first get exposed to the Forex market, it's touted as the 24-hour marketplace that is always open. As long as the sun is up somewhere around the world, there is Forex trading taking place. And while that's true, there are different times during the day when Forex trading is more active than others, and when the major players are more active than at other times. As we look here, there are various market hours. The Asian session is the first session of the day as we get started, and it takes place between about 7 p.m. and 4 a.m. Eastern. So if you are a late night trader and you're living in the States, the Asian session is a great place to start looking to trade any yen cross pairs. If you're looking to trade the Singapore dollar or the Thai baht or the Hong Kong dollar, any of the Asian currencies are going to be relatively active during this time. However, the markets really don't get jump-started until about 2 a.m. Eastern, when the European session opens and trading gets underway in London. And that trading day for those traders who are living in London lasts from about 2 a.m. to 12 p.m. Eastern. Well, during the middle of this trading day, the U.S. session comes online at about 8 a.m. Eastern and lasts until about 5 p.m. Eastern. So we have London, which is the largest trading center for currencies, online at the same time as New York is online for about 4 hours, from the hours of 8 a.m. to about 12 p.m. Eastern. So these are really the most active times in the market. It's a time when there's the most volume that comes through in the market. And you'll notice as you watch pairs like the euro dollar that there are often times when you are watching an intraday chart that you can see the, for instance, the euro gaining strength in the early morning from about 2 a.m. to 8 a.m. You can see the euro gaining strength and moving higher and higher and higher. And then as soon as the traders in New York come online, oftentimes you'll see a reversal of the trend that was happening in the morning. So if you saw the euro dollar moving higher, you'd then at 8 a.m. see it turn around and start to move lower as the traders in New York come online who may have more of a bullish dollar stance. Whether that is simply due to the fact that they live in the U.S. and they are naturally a little more bullish or biased toward the dollar, or whatever the reasoning is. Maybe they see that they think that the currency pair has been bought up a little too much in the early morning hours, and they come in and try and take some profits out of it and move things down. You'll often see that right at about 8 a.m. there is a trend change on the euro US dollar. Now, if there has been something happening in the global marketplace that really skews the fundamentals of a currency pair in one direction or the other, and the trend starts during the European session, oftentimes that trend will continue during the New York session. But as you go back and look at some of your intraday charts, go and try and identify 2 a.m. and 8 a.m. And you'll notice that at 2 a.m. that's really when oftentimes you'll see currency pairs trending flat, and at 2 a.m. they'll break out one direction or the other, and then more often than not when traders come online in New York, they actually reverse the direction of the trend and take some profits off the table. So there are definitely more active times and more liquid times to be trading in the market, and that the most liquid time is that overlap between the European and US markets from about 8 a.m. to 12 p.m. Eastern. So, the next Forex mystery I wanted to talk about is how dealers hedge their risk. I often hear wait, before I go on to this, I want to answer this question from Jeff. Do you think that it is most effective to trade the currency pair that is associated with the market you are trading, i.e. trade yen during Asian markets? Yeah, I do think during the Asian markets, focusing on the yen is definitely the best place to be. During the U.S. markets, the nice thing is if you're able to trade during U.S. markets is the U.S. dollar is associated with about 90% of the currency trades out there. So whether you're trading the dollar yen or the euro dollar or the pound dollar, if you're trading during US hours, you're going to see a lot of impact from the dollar side of that currency pair. But if you are interested in trading the yen, you can also do that during the Asian sessions as well. Do these times apply when the clocks change? They're close. If you are living in Europe and the daylight savings changes in, for instance, this spring, daylight savings was earlier in the U.S. You will have to account for that difference. But currently, so if you base it on Eastern time, I know in the U.S. we have switched to daylight savings already. So going back to this page here, these will actually get closer to each other and be thrown off for about 3 weeks or so during that daylight savings switchover period. But these times are all based on everybody being on the same daylight savings time. All right, so how do dealers hedge the risk? And when I talk with a lot of traders, they will say, well, I've heard that my dealer will take my trades and match them up with the trades of somebody else over here, and they make sure that it's matched up, and then sometimes they'll take the opposite side of it. Sometimes they'll match it up with someone else who is taking a trade, and really in all of the dealers that I have spoken with, and I've actually been on the trading floors for a lot of various dealers, they don't do individual matching. It would be far too cumbersome a process to try and manage their book of business if they tried to match each trade with some other individual who is in the opposite position. What they do is they combine all of the trades on their books, they see what net exposure they have left over, and then they hedge for that exposure. So for a really basic example here, if they have clients who are long 100,000 euro dollar contracts, but they also have some clients who are short 17,000 euro dollar contracts, they have a net exposure of $83,000, or sorry, 83,000 full-size contracts that they need to account for and that they need to hedge against. Now, I said this was a simple example, and that's because I did it based on the currency pairs. What a dealer will actually do is they will combine all of their trades that involve the euro. So they'll look at all of their euro dollar trades, all of their euro pound trades, all of their euro yen trades, on and on and on, and they will see what their net exposure to the euro itself is after combining all those trades, and they'll hedge against that. Then they'll combine all of their trades that deal with the pound dollar, the pound yen, the pound franc, everything that they are trading that involves the pound. They'll see what their net exposure to the pound itself is, and they'll hedge for that. So it isn't something where they go in and if you put on a trade with 5 mini lots, that their system spiders out and tries to find somebody with the opposite trade and match you up with them. They just dump it all into one big pot, and they see what's left over, and they hedge against that. Otherwise, they really wouldn't be able to update their book of business and keep their hedges in place as the market went on. Now, I want us all to remember this aspect of how dealers hedge their risk as we move on to the next mystery of the Forex market, and that is large dealers don't stop hunt. I hear a lot of quote-unquote conspiracy theories out there that someone says that their dealer saw that they had a stop loss set 20 pips below where the current price was, and they moved their stops, or they moved the price of the currency pair to come down take out their stop and then they moved it right back. Well, if you go back to our previous slide of talking about how a currency dealer hedges their risk, they're not able to uh, pick out individual clients and their stop losses and go stop loss hunting. They are trying to manage a huge book of business, hedge against their risk. They aren't worried about going in and taking out one of your trades to make an extra $20. It's not even on their radar. And one of the things, there are a couple of reasons why um, the conspiracy theory, for me anyways, falls apart. If you have a dealer, the dealer is going to, well, the dealer makes money from you when you trade, and the more often you trade, the more often you pay that spread, and the more money the dealer makes. So it's in the dealer's best interest for you to be a successful trader and to keep making trades and to keep paying that spread each time you enter and exit a trade. So they really don't have an incentive to try and deplete your account. Second, they don't have the capacity to just go and try and take out your trade in a mini account. Really, for most people out there, we're small enough fish compared to the big picture of what dealers are trying to control and hedge against, that they aren't able to go get your stops. I had a comment here. Your loss is their gain. Why not? Well, your loss isn't their gain because they are hedging against the positions that you were in. So they're offsetting the trades as you go in. Again, they look at all the trades that they have in their book of business, and then they are hedging because they don't want to expose themselves to any undue currency risk. A question here from Alan Schwartz, which is a great question. Now, why do dealers expand their spreads during volatile times? And I know that, well, the the answer is when the markets are volatile, it is much more difficult for the dealers to offset their trades and to get your trades filled because prices are moving so quickly. And dealers try to have a guarantee, well, it's a quote unquote guarantee, that they will get you in at the market price that they have stipulated, that you stipulate in your trade, that there won't be any slippage. And when markets are so volatile, they have a harder time filling their orders on the interbank market, and thus they have a harder time, again, quote unquote, guaranteeing your entry. And so, getting you into that trade, you'll notice all the time that during the volatile market times, it's harder for them to get into their trades, and so they have to build in a wider cushion on the spread for their trades. Let's see. Boyke says, but our orders are among the large orders, and I certainly hope that's the case. I hope that we are definitely the ones with the account sizes large enough to be moving the markets. Andrew asks, is there any restrictions on insider trading on Forex markets? And I'm not sure what you mean by insider trading. I know in the stock market world, insider trading would be trading on inside information. And so I'm guessing you're saying, if somebody knew ahead of time what the U.S. unemployment numbers were going to be, or what the U.S. GDP numbers were going to be, or something like that, if they use that information to get into a trade ahead of time. I am not 100% sure, but I would imagine that there are restrictions against that, and somebody could have charges filed against them if they used non-public information inappropriately. CBJ says, indeed, Wade, on that level, the institutional dealers really have no concerns with the retail aspects. There simply is not enough overall capital in that sense to be more concerned with. They're more concerned with each other as opposed to us out here on the retail side of the equation. Yeah, it's true. They're concerned with their book of business as a whole, and not necessarily with someone with a $20,000 or even a $50,000 account. Not a true market when trading with a bucket shop. From Pip Guru. Yep, if I know that there are some dealers out there that operate more like a small bucket shop. More of them lately have been being shut down as the NFA has tightened its regulations on FCMs. But if you're looking at any of the major dealers, they're all getting their quotes from the same places. They're getting their quotes from the large banks, like a Deutsche Bank or a Citibank, that comprise the majority of the interbank market. And so, really, regardless of who you're trading with, if they're a large enough dealer, they're all getting their quotes from the same place. They have to hedge their risk all in the same market as everybody else does, and so it's there's really not a way or an advantage for a dealer to try and skew their market prices away from what everybody else is offering, because they have to hedge their risks in the same marketplace that all the other dealers have to hedge their risks. Now, if they wanted to take on that currency risk and make a gamble that the markets are going to move one direction or the other, I guess there is the potential that they could skew it, but that's not what they're in the market to make money with. They're in the market to make money by providing you an opportunity to get access to that interbank market. Let's see. Andrew asks, is any dealer large enough to affect price? Boy, I wouldn't think so, simply because it's not the dealer who would be moving the price. It would be the account holders within the dealer, and I can't imagine that there would be many times when there would be a large enough consensus among the traders who trade through a particular dealer that they would move the markets. Now, I may be wrong. There may be times when they do have some impact, but it would take a large consensus of all of the account holders within that dealer to actually move the markets that way. And let's see. Is it possible for this theory to be true in currency futures, which has volume in the low thousands, like 5,000 on the 15-minute Euro June contracts? Boy, I am not sure. I'm guessing you're referring to, do people go out and stop hunt with the currency futures? I would imagine if there were a trader out there who had a large enough stake, they could move the market, but it wouldn't be to go out and hunt specifically for your stops. They may be testing price levels and seeing if some stops are set there and if they can maybe trigger a cascade of stop loss triggers that would continue to move their position in a favorable manner, but they wouldn't be out hunting for individual traders' stop loss positions. They just don't have that information. So, when central banks intervene, do they have their own dealers to do this? They will intervene in multiple ways, and they will send, but they do have to send money through the large banks that operate the core of the interbank market, like a Deutsche Bank, like a Citibank. That they will move their money through those institutions. Let's see. Do you know how much capital is provided by retail traders? They do, and it depends on. Retail traders do provide good liquidity. It depends on what your definition of a retail trader is, but the the speculators as a whole, whether they be hedge funds, whether they be individual traders like we are, as a group, speculators do provide quite a bit of liquidity to the market. Okay, I think we've got through those questions there. I appreciate the participation. I wanted to move on to the next mystery of the Forex market and look at calculating pip values. I don't know how many of you have ever seen this equation here, but oh, okay. Sorry, before we go to this, there is one more comment over here from Pip Guru. He says, pound yen spread of 9 on interbank, that's not real when an ECN can be at 3. Um, Now, the spread from dealer to dealer can change depending on how much the dealer wants to make each time you enter and exit a trade, and what they feel is justified by what they offer and what you'll pay. Uh, you'll notice that more and more dealers have been tightening their spreads considerably. It used to be you traded the euro dollar and you had a spread of 7 or 8 pips. Now you can trade with dealers that have spreads of less than 2 pips. You can, or less than 1 pip in some cases. So, but then if in those cases, oftentimes you do have to pay a commission. So it depends on the dealer you're using and the spread that they charge. They have full control over. But whatever that spread is, it will move where market prices move. So they may be charging a ridiculous 5 pip spread on the euro dollar, but as the price of the euro dollar goes up, their bid and ask are going to go up with the price of the euro dollar. So they're not manipulating the price. They are tacking on an extra fee by having an extremely wide spread, and you have full control over whether you want to participate in that or not. You just find a new dealer. And as more dealers have come into the market, competition has increased. You've noticed that spreads continue to tighten, and that's great for us as traders. So having a wide spread isn't market manipulation. It's not price manipulation. It's just charging you a fee. So so yeah, I agree 100% with Pip Guru. Try and find a dealer that is not going to bend you over on the spread, and you'll be much better off in your trading. So back to calculating pip values, uh, the formula or equation is right here. You find the pip size divided by your first exchange rate, and exchange rate number 1 is the exchange rate of the pair you are analyzing. Then you multiply it by the lot size, and then you multiply it by the exchange rate number 2, which is the exchange rate between the base currency of the pair you're analyzing and the US dollar, and that will give you your pip value. So the first example here that I have is of the pound yen. So let's take a look at a few of these things. The pip size for a pound yen contract is 0.01. As all of you know, any currency pair that is quoted in yen only goes over 2 decimal places. So that is our pip size, is 2 decimal places, 0.01. The exchange rate, when I looked at this morning and plugged it into the slide, of the pound yen was 198.66. Now let's say we're trading a lot size of 10K or a mini lot, and the exchange rate between the pound dollar is 1.9967. So to calculate the value of 1 pip on the pound yen, we would look at this equation. 0.01 divided by 198.66. Then you would multiply that by 10,000. And then you would multiply that by 1.9967. And each pip on the pound yen is worth $1.50. Now, a few years back, well, even last year, a pip on the pound yen was only worth about 92 cents. But with the exchange rates moving the way they have and the yen gaining so much value and the dollar losing so much value, the value of one pip on the pound yen has increased over the past year. So, again, you find the the pip size, the exchange rate for the pair you're analyzing, multiply it by your lot size, and then assuming that you hold your account in dollars, you would multiply it by whatever the base currency is of the pair you're looking at times the current crossed with the currency that you hold your account in. So in this case, it's dollars. Andrew adds a question: do all dealers quote in tenths of a pip now? I have seen quite a few of them moving to that. Not all of them do. Again, it's another way of trying to add value and to cut into that spread a little bit so that they can attract more clients. So I know some do, but not all. So that was an example of the pound yen. Let's take a look at an example of the euro dollar. Now, in this case, the exchange rate 1 and 2 are going to be the same because we are already looking at a pair that is quoted in dollars. So we're analyzing this pair. And in this case, the pip size is 4 decimal places over instead of just the 2 like the pairs that are quoted in yen. So we have a pip size of 0.0001 divided by the exchange rate between the euro dollar, which this morning was 1.5669. Multiply that by 10,000. Multiply that by the exchange rate, and in this case it's the same exchange rate because we're looking back to dollars, and each pip size, or each pip is worth $1. The last example here is the dollar yen. Now in this case, since the dollar is the base currency of the pair that we are analyzing, our exchange rate is going to be the exchange rate between a dollar quoted against a dollar, because we're trying to understand what the base currency, again, of the pair we're analyzing is compared to whatever currency we're holding our account in, which in this case is dollars. So again, the pair that we're analyzing is quoted in yen, so its pip size is only 0.01 divided by the exchange rate, multiplied by 10,000, our lot size, and then multiplied by the exchange rate of a dollar to a dollar. I could trade you $1 and for $1. I'm not going to get any more, I'm not going to get any less. So you multiply by 1, and you come out with an exchange rate, or a pip value, of 1.002. So those are 3 examples on calculating pip values. Next, I want to I like this comment from Boyke. If stops are correctly placed, they are out of hunting range. And that's true. If you have your stops above resistance levels or below support levels, and are giving the currency pair room to breathe within its normal volatility, they are definitely out of hunting range. So let's take a look at calculating rollover. Now this is extremely valuable for you if you are a carry trader, which as of late it has been quite difficult to be a carry trader if you're using the yen as your carry trade currency, simply because with the risk adjustments in the market, the yen has been gaining strength at an incredible rate. But as the markets start to stabilize a little bit, and as you look at doing carry trades with yen-based currency pairs and also other currency pairs that aren't yen based, it's important to know what you are getting out of your carry trade. And really, the reason we participate in carry trades is because we get a daily interest payment or interest credit at rollover. Depending on how your dealer does it, they may just put a cash deposit into your account, or they may adjust the entry price of the trade you're currently in to a more favorable entry price. But as we look at this equation, this is what we can do. We have our lot size times the rollover period, and the rollover period is typically 1 day. In most of your accounts, you're going to have rollover every day at 5 p.m. Eastern, but then sometimes, usually once a week, there you will get credited for 3 days of rollover. And in some brokers, they do this on a Wednesday at their rollover. Some dealers, they do it on Friday. So it depends on who your dealer is as to when you're going to get that triple-sized rollover payment. So a rollover period multiplied by the interest rate, and the interest rate that you use is the spread between each economy's LIBOR rate, or the London Interbank Offer Rate. And then you divide all of that by 360 or 365. And here's the key with that. If you are trading a pair that has the British pound in it, you use 365. Any other pairs, you use 360. And that gives you your rollover value. So let's take a look at an example of the pound yen. We're going to assume we have a lot size of 10,000, or a mini lot. We have a rollover period of 1 day. Then our interest rate is the spread between the LIBOR rates of Great Britain and Japan. So the LIBOR rate in Great Britain is 5.58% minus 0.63%, which is the LIBOR rate in Japan, gives us a spread of 4.95%. And then we are going to, in the end, convert this all back into dollars from pounds. So the exchange rate from pounds to dollars, again, is 1.9967. So if we plug all this in, a lot size of 10,000 times 1 day of rollover times 4.95% divided by 365, and again we're using 365 because the pound is involved in this trade, gives us a daily interest payment or rollover payment of 1.356 pounds. Now if you have an account that is denominated in dollars, you'll want to convert that into dollars, so we take the pounds multiplied by the exchange rate, and that gives us a $2.71 interest payment. CVJ asks the question, and with the carry aversion of late, the rollover is even more crucial to be mindful of as to not pay the interest. Yep, absolutely. If you are going short the pound yen, instead of receiving a rollover payment, you actually pay a rollover payment. So you do have to make sure you're on the right side of the trade when you are looking at doing trading any of these quote-unquote carry trade pairs that have a large spread between their interest rates. Now, I wanted to go into one more example with the Kiwi Yen here. And again, we're going to use the same assumptions: a lot size of 10,000, a rollover period of 1 day, but the interest rate is going to be different because the LIBOR rate in New Zealand is much higher than the LIBOR rate in Great Britain. So we have a LIBOR rate of 8.51% minus 0.63% gives us a spread of 7.88%. Now if we look back at the pound yen, we only had a spread of 4.95%. So going back to the Kiwi Yen, 7.88% is almost 3 percentage points higher. And then we have the exchange rate between the Kiwi dollar, and that's 0.814. So if we plug all this into the equation, we have 10,000 times 1 times that LIBOR rate spread divided by 360. Again, we used 360 here because we don't have the pound involved in our trade. And then that gives us a daily interest payment of New Zealand dollars 2.188. So 2.188 New Zealand dollars. Now we do have to convert this back to dollars if we hold our account in dollars. So we multiply that payment by the exchange rate, which gives us a payment of 1.78. So $1.78. Now, as we look at this, we say, okay, the interest rate spread for the Kiwi Yen was much higher, 7.88%, than the spread for the pound yen. However, the daily payment I'm receiving, 1.78, is almost a full dollar lower. It's about 66% of the value of the payment that I would have received from the pound yen, where I got 271. But the interest rate is much lower in the UK, and so as you look at this, the reason is the exchange rate. The exchange rate makes all the difference. If the exchange rate between the pound and dollar wasn't so high, this interest payment wouldn't be so high. But because the exchange rate's high, we make almost 30-40% more on this payment than we make on the payment from the Kiwi Yen. So that's one thing to keep in mind when you're looking at doing a carry trade is don't just look at the interest rate differential between the economies. If you were to do that, the Kiwi would beat the pound hands down, because the interest rate in New Zealand is much higher than the interest rate is in Great Britain. However, because the exchange rate has to be factored into the equation, it is actually more advantageous to you to receive interest payments based on the pound yen than it is to receive interest payments based on the Kiwi Yen. Now, Boyke had a question, why 365 on the pound and 360 on the others? And honestly, I don't know. I just know in talking with various trade desks from different dealers that is the convention in the system. So now Pip Guru says if you go in at 5 minutes before the close, you still receive a full payment of interest. And that is true for most dealers. I know that there are some dealers out there that actually pay the interest out on a continuous basis throughout the day. So if you hold a trade for half of the day for 12 hours, then you get credited half of the interest payment. While other dealers, if you are in the trade at the time of rollover, which is typically about 5 p.m. Eastern, you get the full interest payment. Boyke says the UK has a longer year. Maybe so. So, that is the last Forex mystery I wanted to discuss today. I have thoroughly appreciated your participation and your feedback, and have enjoyed this time. I hope that having some of these quote-unquote mysteries revealed to you will be helpful in your trading as you are looking at what strategies to adopt, how understanding exactly how things work in your account, and that it will help with your future trading success. If you have any questions, please send me an email to Wade at PFX Global. I just got a request for the slides for this. If you want a copy of the slides that I used today, send me an email with your email address, and I will send them back to you. A video of this presentation will also be posted here on FX Street. So again, thank you for your time here. Best of luck in your trading, and we will talk with you next time.